everyone, excited to have you guys here today. Going to be doing something a little bit different, but I wanted to give you guys tangible evidence of what I'm actually doing here, going through and evaluating if companies are what you want to keep following and keep trying to understand going deeper, or if it's something you just want to pass on. So with that, we're going to be jumping into just you guys seeing my screen as I go through and just show my process. So want to let you guys know too, this is just my opinion. It's not investment advice. I am not the biggest expert on this planet by any means or any measure, but hopefully you guys can follow along and find something a little bit valuable, and it's a chance for me to get to share that. So hopefully you guys like it. Popped over here to FinViz, where I talked about in one of my previous videos where I like to actually come through and sort for companies that are down below their all-time high. You can see I've got it sorted 70% or more below that all-time high. One other thing that I actually wanted to share before we get started is the only other filter I like to have on here is this for their market cap. So it sorts out, we only look at companies that are over 50 million. Just that sorts things down a little bit for us. I don't want to be looking at some of the smallest companies that are listed. Want to keep it to companies that have at least some track record of growing. If they're under 50 million, they probably are either just barely getting started or have absolutely gotten beaten up and are on the brink of bankruptcy. So want to get those out. And even if I miss some opportunities in there, that's okay. I'm okay with errors of omission. But with that, we'll kind of jump in. The other thing that I like to do is I like to come in here and sort this by market cap. So that way I am looking at the largest companies that are down 70% or more from their high. So I've already gone through and done a lot of these. So we're actually going to skip all the way to page 7. I've already gone through all of the previous companies before this. I most likely am not going to know a lot of these, but some of them I may know off the top of my hand, but you guys will just get to see my entire process here. So get a little bit of that. So what I'm going to do is I'm just going to go down the list, starting right here, and maybe go through, we'll see how many we get through today, just depending on time, but you guys will get to see my process of what I actually do. Again, I hope you guys find it valuable. Just let me know what you think, and if this is something that you appreciate, someone going through and showing you what we're actually looking for, what I'm looking for. So first ticker is AUR. All right. And the first thing that I'm actually going to come and look at, just taking a quick year at their chart. Looks like they've obviously been really beaten up, but they haven't been on the market for that long. So that might actually be one of the reasons why we do not want to look at this company at all. So after we pulled a company up, the first thing that I want to go look at is a little bit of their information and what they actually do to see if it's a company that I can understand. So Aurora, design and development of automobile hardware, software, and provisions of data services. I know there's been a few companies like this that are providing, not actually selling the vehicles themselves, but maybe providing some of the parts or services to those auto producing companies that have gotten a little bit beat up. I can see this is only IPO'd in 2021, which means we don't have a lot of data here. And honestly, I really don't like that. And so just based on this, the only thing I'm going to look at just to see if it is an absolutely fantastic buy, I'm just going to come and quickly look at their cash flow and see, yeah, so their free cash flow is negative, and that is an immediate no. So we're going to pop back over, look at our next one, CVNA. Carvana. I am actually immediately going to pass on this one. I'm not a fan of Carvana, and if I had to guess, I know that they've had cash flow all over the place. Yeah, you can see it was their very first first time in the trailing 12 months that they've had positive free cash flow, and definitely don't like that. So we're not even going to worry about them. Going on to the next one. KRG. All right. There's been a lot of REITs that have really been beat up. So this one might be worth looking into, but may not. So Real Estate Investment Trust. Retail. Okay. All right, let's come and look at their cash flow. Some of the very first things, and I'm just wanting to, through this, see, is this a company that I want to do more work on, or is it one that I just want to pass on? I definitely like this. Looks like they had a lull in cash flow, and since then have grown a lot, up to 257 million of net free cash flow. Which is good. And a market cap of around 4.7 billion with only 270 million of trailing 12 months free cash flow. That's a pretty high multiple for, especially for something in this sector. Yeah, that's too high right off the bat. So I'm just gonna go ahead and exclude that one. So let's go to the next one. QDEL. All right, all right, Vitro Diagnostics. This is one that I'm just going to pass on right away. I don't have the knowledge that I would need for a lot of medical companies, especially ones that have anything to do with genetic testing or drug development or anything like that. There's just so many out there right now, and I don't have the expertise to understand what's going to be a winner, what's not, what has an actual shot at getting big. So we're just going to go ahead and skip that one right away. RIG, I believe I've looked into this one before, but let's take a look. To remind myself of what they do. Offshore drilling, yep, for oil and gas. Let's come and look at their financials. And see what their cash flow looks like. Negative free cash flow. I don't like that. A lot of these, when you have a company that has really high, it's capital intensive, they often tend, at least from what I've seen, they just really struggle to have sustained periods of consistent cash flow, really consistent anything, just because they're so reliant on the prices of commodity, and it's so competitive just because there's so much money to be made that margins are just suppressed down to nothing. So I'm gonna go ahead and pass on this one right away. You've got negative free cash flow and just kind of all over the place. So might be missing something, but that's all right. PRGO. They are a high flyer, 2015. Most of the companies that we look at had crazy peaks around 2021, when all that free cash was just sitting in the market and people were just throwing at really anything. All right, health and wellness, Dublin. Yeah, this could be something that I look into. It's much more of a direct to consumer and just more simple type of business than a drug or genetic sequencing or anything like that. So, all right, generating in the last 12 months about 300 million, but looks like in the past it's generated a lot more. So this could be one that, you know, you're looking for a rebound. You can see why in 2015 that they had such a high price there. We're flying about 1 billion free cash flow. So this actually could be one, you know, if you're looking for a company that's turning around, right? We can see that things got really choppy here. You definitely have to do a lot of work to see, hey, is this a company that, you know, could have a turnaround here. So just come look at a couple things really quickly. Their price to free cash flow. Yeah, it's actually pretty low right now. They've historically been much higher, maybe around 20, and we're down 15. So could be something that's interesting right now. I'm a little curious. Now, this is where, you know, right off the bat, I'm not saying no. So we got to say, hey, what is it looking like? It looks like revenues are growing, and pretty consistently, but at a subdued amount. So maybe it's a company that, you know, is just getting re-rated because it's not growing really that fast at all. And in the past, maybe it was a little bit more. Curious. No, it looks like it's always at least very quick check there. Let's come back and look at some different metrics to see what the gross margin's been doing. Gross margin has been flat to down. Don't love that. Net margin has been down, but recovering back, coming back to being profitable, which is again interesting. Turn on equity, flat down. Yeah, this is a company that I think could be interesting, one that I'd want to do a little bit more research on. Didn't even know that they paid dividends. Honestly, I don't know that I love that. Been increasing it. So this is probably, let's see what are analysts saying, at least for price targets and things. The analysts think that it's undervalued. I really don't love using analyst ratings just because generally their opinion follows the trend. Whatever trend the company is in, that's what it seems like they follow. So as the stock goes down, they lower their estimates, and as it goes up, they raise them. Yeah, this was probably a good one to grab down at the bottom, but I think it, you know, could be worth a little bit of work. Last thing, let's just take a look at their balance sheet. Again, this is not me saying this is a company that I want to invest in. This is me saying, hey, there's a potential. This company seems to at least be fairly solid. Their revenue isn't, you know, falling, but I'd want to do a lot more work to say, you know, what do they have, and what are their prospects. So, all right, so current assets, we got about 600 million in cash. Current liabilities, around $1 billion. We've got some receivables. So at least as far as this goes, seem to be okay. $6 billion. Not terrible. Not a terrible balance sheet. They're not in any immediate danger. Hopped over here to the insider trading, and you can see there's been a lot of buying going on by some of the top executives in the company. So I really like to see that for sure. It tells me that even though, hey, the company's maybe in a little bit of a rut right now, they believe in what they're doing. They believe in the long term. So I definitely like that a lot. This is a company that would probably go on my list of, hey, let's look into it more. Let's understand the management. Let's understand the industry. Let's understand this specific company's future versus competitors. We still got a long way to go before it's given the green light to say, hey, we want to look at actually adding this company at a specific price. So give you guys an idea. Going on to the next one, FUTU. And I think I may have looking at this company a long time ago. High all the way up to 60. I don't know, this is one that would have enough margin of safety. I don't know. We'd have to look into first and see actually what they do. Digital financial services, fintech company. All right, let's look into their financials. We have very little information, which I do not like at all. I generally want a lot of years to kind of compare. Although, obviously they're producing free cash flow here, but it's not in USD, so makes it a little bit harder to compare. But let's come over and look at maybe things like margins. Got a fantastic margin. Wow. Gross margin of high 80s. Been increasing, as you guys could see. Had a little dip there, but kind of turning to that trend. Net margin, again, increasing. I will say I like this a lot. This is a company that would probably take a lot of work because we don't have a lot of information of maybe how they've handled past events and things, but you can see they grew through COVID. It was after that they had their dips, so you'd want to understand better what these guys do. Have a 2.2 price to free cash flow, so that tells me there is something else going on here as to what is going on, but it is one that is interesting enough for me to say I want to look into them more. I remind myself. This company is in China. That alone probably tells me I want to exclude them altogether. There's a lot of companies in China that you don't feel exactly comfortable, and I've seen a lot of things like this where it looks so good on the surface. It looks like something is going on, and then you dig into a little bit, do a little bit of searching, and you see, oh, this is blatant fraud, and that's why it's selling at these multiples and things like this. I'm only going to be looking at the highest quality companies in China, so for that reason, we got a full pass there. So kind of gives you as an idea of what I'm looking for. We'll just do a couple more here. So PTEN. All right. Drilling. All right. Yeah, it could be interesting. Oil and gas drilling here. If I had to guess, it's probably similar to the rig that we looked at earlier. The margins and things they just make it hard to want to get a part of until it is so beaten down that there's no sellers left, really. So let's take a look at cash flow. Yeah, you can see free cash flow is all over the place. Let's look at trailing 12 months instead of quarterly. Yeah, it's all over the place. You can see we go from times of having some free cash flow to really negative to right back and forth. It just happens when you've got such a competitive environment in that's capital intensive. Makes it hard for them to really ever feel like they can make money long term. Just curious, wanted to come look at the price to fleet cash flow just because I was curious. Yeah, it's just all over the place. You can see right before things, as things start to fall, things get crazy. Got crazy multiples. It looks like, honestly, it's probably on its way up, headed towards one of these again, where it's going to spike and the company's going to start to lose money. So don't like that, and we're just going to pass on it. So DXC is our next one here. All right, tech consulting company here. This is probably one that I don't know a lot about, but it's one that I'd be willing to do the work on to try and understand. Yeah, it's a crazy chart. I guess it's only up to 80, dropping down all the way to around 10-ish. It's crazy. Let's take a look at their financials real quick, see if they're generating a good amount of cash. Looks like it's a little rocky for sure. Gone through a couple periods where things decline and come back. I don't love this for sure. 748 million last trailing 12 months. With their price to free cash flow, it's pretty subdued, but I don't know, maybe it's not even that. It looks like this company has not gotten, maybe typically not that high of price to free cash flow. Honestly, I'm just not liking what I'm seeing here. It's not an industry that I feel like, or a company that I feel like I could understand super well. So I'm just gonna go ahead and pass as well. So let's go on this next one. This will probably be our last one that we have here. NTCO. All right, this company sells cosmetics, fragrance, and toiletries. IPO'd in 2019, means we're not going to have a lot of information. It's December 2019. Definitely one that I could understand. He's gotten absolutely beaten up. IPO'd, rode up with all the free money. So let's quickly take a look at metrics. Actually, let's come over to cash flow first. They are not producing. They were producing cash. Yeah, no, don't like this at all. Yep, this is probably one we'll just pass on. Well, it could be interesting. It's always interesting to look for turnarounds, but they take a lot of work. Which is fine, because you can find some really, really fantastic companies, but there's oftentimes a lot easier things to look at. Quickly, let's just take a look. Their income is falling. It has been falling for quite some time. So I don't like that at all. Probably just for that alone, we're not going to worry about touching them. Generally, companies like this that have issues, you'll see it fall really sharply, and then for maybe even 1 or 2 quarters, I guess not necessarily always, but you'll see it fall sharply and have kind of a rebound. But when you see really slow, consistent declines over 8 quarters, with one big dip in there as well. It's not something I like at all. Again, might be missing something, but it's something that I'm willing to pass on. So we're gonna not worry about that, and kind of finish up with what do you got for you guys here today. Hopefully this part was valuable, getting to kind of see a little bit of what I'm looking at. Again, I am not an expert or the best at this by any means, but wanted to share this with you guys because I think there's a lot of people trying to learn, and hopefully it was helpful. Hey guys, hopefully that was valuable for you. I just want to thank you for sticking around. It means a lot for sure as I'm trying to kind of learn this. Hopefully you got some value out of it, but let me know in comments just what you guys thought, what was really rough and not valuable at all, and what was. But hopefully you can see a little bit of what I do to try and identify companies that I think are valuable. You can see most of the time I am just passing, and that's okay. One of my favorite things that Warren and Charlie talk about is they throw almost everything in the too hard pile. And so that way they can only focus on the easier decisions. And I think why not follow in those footsteps when you've got some of the best investors telling you exactly what they're doing. Stay within your circle of competence, and you're going to find yourself with opportunities that to you are very clear and understandable and feel like an absolute no-brainer. So you guys can kind of see that process in work, at least the very, very beginning of it. There's a lot more that goes in behind the scenes, and I'll be showing you guys more as we go. But again, thank you, and we'll see you in the next one.